For the last decade, the Bitcoin market came with a simple calendar. It was a predictable 4 year rhythm that for a long time seemed to dictate everything. You bought during the quiet times, held on for dear life during the euphoric explosion, sold near the top, and waited out the winter. It was a pattern governed by a single powerful event, the Bitcoin halving. This clockwork mechanism, cutting the new supply of Bitcoin in half every 4 years, created earth shattering bull markets in 2013, 2017, and 2021. Traders built entire careers and fortunes around this one recurring theme. But if you're still staring at that old calendar, you're playing a game that's fundamentally changed. The rules have been rewritten, the field has been redesigned, and the old clock is no longer the only thing that matters. Many analysts are now debating if the 4 year cycle is still the dominant force it once was. It's a bold statement, and one that goes against years of crypto wisdom. But the evidence for a major shift is overwhelming. The old cycle hasn't just been altered, it's being overshadowed by new, more powerful forces. Forces that have less to do with Bitcoin's rigid code and everything to do with the corridors of power on Wall Street and in the treasuries of nations. The era where predictable supply driven cycles were the only story is over. Welcome to the new era, an era of sustained demand driven growth, where Bitcoin is no longer just a retail phenomenon. It's now a strategic asset for some of the most powerful institutions on earth. And in this script, I'm going to lay out the evidence for this paradigm shift and what this new reality means for you. Before we can understand why the old model is evolving, we have to respect what it was. For over a decade, the 4 year cycle was the most powerful narrative in all of finance. It was almost like a law of physics for the crypto world, beautiful in its brutal simplicity. It all revolved around the halving, an event programmed into Bitcoin's code by Satoshi Nakamoto himself. Approximately every 4 years, the reward that Bitcoin miners receive for securing the network gets cut in half. This drop in the new supply of Bitcoin creates a predictable supply shock. Assuming demand stays the same or grows, the price is algorithmically pressured to go up. This single event gave birth to a distinct four-act play that repeated itself with uncanny regularity. Act 1 was the breakout phase, or the pre-halving rally. In the months leading up to a halving, anticipation would build. Sophisticated investors and crypto winner survivors would start accumulating Bitcoin, knowing a supply shock was a mathematical certainty. You'd see the price slowly grind upwards, breaking out of the long slumber of the bear market. This was the market waking up. In 2012, the price moved from single digits to around $12 before the halving. In 2016, it rallied from the low hundreds to about $650, and in 2020, it climbed from the depths of the COVID crash to around $8,700. The pattern was clear, the smart money was getting in position. Act 2 was the hype phase, the post-halving bull run. This is when the magic really happened. After the halving, as the supply shock took hold, a powerful narrative would spread like wildfire. The media would pick up the story, new retail investors would flood in, and suddenly everyone was a crypto expert. This is where we saw the truly parabolic, life-changing gains. After the 2012 halving, Bitcoin peaked at over $1,150. After the 2016 halving, it hit nearly $20,000 in the legendary 2017 bull run. And after the 2020 halving, it surged to its then all-time high of around $69,000 in 2021. This phase was pure adrenaline. But what goes up must come down. This brought us to Act 3, the correction phase, better known as the soul-crushing crypto winter. Once the hype reached its peak and there was no one left to buy, the market would turn, and not just dip, but collapse. These sell-offs were violent, with gut-wrenching 80% to 90% drawdowns from the top. After the 2013 peak, Bitcoin crashed to the low hundreds. After 2017, it bottomed around $3,200, and after 2021, it fell below $17,000. This phase washed out the tourists and tested the conviction of even the most ardent believers. Finally, after the storm came Act 4, the accumulation phase. The price would find a bottom and trade sideways in a long, boring range. The media would declare Bitcoin dead for the 100th time. The tourists would be gone, and only the true believers were left. In this quiet phase, the groundwork for the next cycle was laid. Patient investors, understanding the rhythm, would steadily build their positions, knowing the next halving was just around the corner, ready to kick off the symphony once again. This four-act structure was the metronome of the market for more than a decade. It was driven by supply and predictable in its pattern. It was the old world, and while that world isn't gone, it's not the whole picture anymore. For years, the cycle was law, but in late 2023 and early 2024, the first major crack in that foundation appeared. For the first time in Bitcoin's history, it broke the established script. Bitcoin made a new all-time high before the halving. Let's just pause and appreciate how significant this was. In every previous cycle, 2012, 2016, and 2020, the new all-time high came many months after the halving. The halving was the starting gun, not the finish line. But in March 2024, a month before the halving, Bitcoin blew past its 2021 high of $69,000, reaching over $73,000. This wasn't supposed to happen. It was like reading a familiar book and finding the ending printed in the middle. The community of analysts who had built their models on the rock-solid foundation of the four-year cycle had to ask, what's going on? What has changed so fundamentally that the most reliable pattern in crypto is breaking before our eyes? Some dismissed it as a one-off. Others claimed the cycle was just front-running itself. But that explanation felt too simple. This wasn't a minor deviation. It was a signal that the market's fundamental drivers were being reordered. The pre-halving all-time high wasn't the cause of the cycle's evolution. It was the first undeniable symptom. It was the flashing red light on the dashboard signaling that the engine that had powered Bitcoin for a decade was being upgraded with something new and far more powerful. The old supply-based narrative was being drowned out by a tsunami of new structural demand. And that demand was coming from the most powerful players in the global financial system. The game had changed. The question was no longer just when the cycle would peak, but whether the concept of a cycle defined only by the halving was still relevant. The old cycle was driven by a predictable supply shock. This new paradigm is being shaped by a relentless demand shock. This isn't the retail-driven hype of past cycles. This is structural, institutional, and permanent. It's the deepest pools of capital on the planet waking up to Bitcoin. There are three pillars of evidence supporting this new reality: the ETF effect, the nation-state game, and the corporate treasury. Pillar 1, the ETF effect, the Wall Street floodgate. On January 11, 2024, the floodgates opened. After a decade of denials, the US SEC approved the first spot Bitcoin ETFs. This single event cannot be overstated. It was the formal regulated bridge between the vast pools of capital in traditional finance and the finite supply of Bitcoin. For the first time, any financial advisor, pension fund, or hedge fund could get direct exposure to Bitcoin as easily as buying a share of Apple. The result was a demand explosion that dwarfed anything in previous cycles. Within months, these US spot Bitcoin ETFs began absorbing a colossal amount of Bitcoin, at times buying up far more than miners were producing daily. Look at the king of this new world, BlackRock's iShares Bitcoin Trust, or IBIT. BlackRock is the largest asset manager on Earth, and their entry gave Bitcoin a stamp of legitimacy like nothing before. The IBIT ETF had one of the fastest launches in history, with some reports in late 2025 noting it was nearing an astonishing $100 billion in assets under management, AUM. To put that in perspective, one analysis noted it took the popular Vanguard S&P 500 ETF over 5 years to hit that milestone, a feat IBIT was on track to achieve in just over 400 days. Collectively, by late 2025, US spot Bitcoin ETFs hold a significant portion of the circulating supply, with total AUM surging well over $150 billion. This creates constant structural buy pressure that simply didn't exist before. The best parallel is the first gold ETF in 2004. It unlocked a decade of sustained price appreciation for gold, creating a new, higher plateau for demand. We are seeing something similar with Bitcoin, but on an accelerated timeline. The ETF is a permanent repricing mechanism that has institutionalized Bitcoin, and this change alone is enough to argue the old cycle's dominance is over. But it's only the first pillar. Pillar 2, the nation-state game, the geopolitical asset. The second, and perhaps most profound driver of this new era is the entry of governments. For years, nation states saw Bitcoin as a curiosity or a threat. That's changing. We are now witnessing the dawn of the nation-state game, where countries are beginning to see Bitcoin as a strategic reserve asset, a neutral digital gold for the 21st century. El Salvador's move to make Bitcoin legal tender in 2021 was a historic first step. But the bigger story is what's happening with the United States. While there is no official policy to create a strategic Bitcoin reserve, the US government has become one of the largest holders of Bitcoin on the planet through criminal seizures. Following a record breaking seizure in October 2025 related to a massive crypto scam, the US government's known holdings surged to an estimated value of over $36 billion. Or in the past, the policy was simply to auction off these assets. But the conversation in Washington is shifting. Influential figures like Senator Cynthia Lummis have advocated for safeguarding seized Bitcoin as a national asset. The idea is no longer just to liquidate it, but potentially to hold it long term. Think about what this means. The issuer of the world's reserve currency is now a de facto Bitcoin whale. This changes the calculus for every other nation. Why would a country want Bitcoin? For the same reason they hold gold, as a neutral reserve asset not controlled by another country. As nations see the US accumulating tens of billions of dollars worth, they're forced to ask themselves, what if we don't have any? This creates a game theoretic rush. The demand from nation states isn't cyclical, it's strategic. As this narrative takes hold, the idea that Bitcoin's price is dictated only by a halving event becomes increasingly outdated. Pillar 3, the corporate treasury, the diamond hands. The third pillar is the corporate world. Following the lead of Michael Saylor and his company, MicroStrategy, a growing number of public companies are adding Bitcoin to their balance sheets. They are converting cash from depreciating currencies into the hard asset of Bitcoin. Saylor's conviction has been unwavering. As of late 2025, MicroStrategy has accumulated a staggering treasury of over 200,000 BTC. His mantra is that he is buying the top forever because he views Bitcoin as the ultimate exit strategy, not something to trade based on short-term cycles. What started with one company has become a trend. As of late 2025, it's estimated that a growing list of over 170 public companies collectively hold more than 1 million BTC on their balance sheets. These companies are not day traders. They are long-term holders treating Bitcoin like a core piece of their capital structure. This creates a class of diamond hands, holders unlikely to sell even in sharp downturns. This corporate accumulation removes a significant portion of Bitcoin from the liquid supply, acting as a stabilizing force. When you combine the daily buy pressure from ETFs, strategic demand from nation states, and long-term corporate holding, you have a trifecta of demand that didn't exist before. This isn't cyclical demand, it's structural. The old rules are no longer enough to explain a market being reshaped by the world's largest financial and political institutions. So, if the old cycle's dominance is fading, what does this mean for you as an investor? It requires a shift in mindset. First, the violent 80-90% drawdowns that defined previous crypto winters may be less likely. This doesn't mean volatility is gone. Sharp, scary pullbacks of 30% or even 40% are still possible and should be expected. However, the massive, persistent base of buyers from the ETF, corporate, and sovereign sectors creates a powerful potential floor under the market that didn't exist before. Every dip is now a potential buying opportunity for some of the world's largest pools of capital. This could transform the market from one of parabolic booms and catastrophic busts to a more sustained, stair-stepping uptrend. This means the old strategy of trying to time the top and wait for a 90% crash is now extremely dangerous. You might be waiting for a dip that never comes. Selling everything could mean missing the next major leg up in a long-term bull market. Second, the investment thesis is expanding. It's less about capturing a 4-year bull run and more about participating in a multi-decade adoption story. Analyst price targets reflect this new reality. While predictions are always speculative, some projections for 2025 and 2026 range from $130,000 to over $200,000. Looking further out, respected figures like Kathy Wood of ARK Invest have forecasted models with targets of $1.5 million or more by 2030 based on Bitcoin's growing role as a global store of value. These aren't wild guesses, they are models based on the potential inflows as institutional adoption continues. The new strategy is less about timing cycles and more about understanding these long-term demand drivers. The focus shifts from when do I sell to how much should I hold for the long term. This new paradigm rewards conviction and patience over market timing. It's about owning a piece of a nascent global asset class being de-risked in real time by the world's most powerful entities. For 12 years, we had a map, a well-worn, reliable map based on the 4-year halving cycle. But as we've seen, relying solely on that map could now lead you astray. The pre-halving all-time high of 2024 was the tremor before the earthquake. The earthquake itself is the colossal structural shift in demand that has redefined the market. The first shockwave is the Wall Street floodgate of spot ETFs, creating a perpetual demand engine. The second is the nation state game, introducing a powerful strategic demand force. And the third is the corporate treasury, creating a formidable base of long term holders. Some will argue that the cycle isn't dead, just evolving, and they are right to a degree. The halving supply shock is still a bullish tailwind, but it may no longer be the dominant factor. It's a key part of the story, but it's now joined by a hurricane of institutional demand. The 4 year cycle was a product of Bitcoin's childhood. Now, Bitcoin has entered adulthood. It has been integrated into the global financial system, and its price is now driven by the immense forces of that system. Relying on the old map is no longer just outdated, it could be a massive strategic error. It might cause you to sell too early, wait for a crash that never fully arrives, and miss the bigger picture. The dawn of a new era of sustained demand driven growth. And this new era requires a new mindset. It requires looking beyond the halving and focusing on ETF flows, regulatory developments, and the steady march of sovereign and corporate adoption. It's a more complex game, but it's also a much bigger one. To stay ahead of this fundamental shift and understand how these new forces are shaping the future of money, make sure you subscribe and hit the bell. I'll be tracking this evolution every step of the way. Welcome to the new world.